Okay, we're going to start problem 37. 37 is where the parent purchases 80% of a company for $802,720 cash. We're told that the total value of the company is $1,003,400. That information is told to us so that we can figure out whether or not a control premium has been paid. And the way to do that is figure out what this implies the full value to be. What this implies the full value to be, 802,720 for 80%. 80%, you could divide by 0.8, you get the full value of the company, implied full value based on this price paid, and that number will turn out to be $1,003,400, the exact same number. So we now know that the valuation of the 80% is the same as for the 20% non-controlling interest, because this is what the problem tells us is the full value. So that just is one way of knowing whether we paid a control premium for the right to own 80% or not, and in this case we didn't. We're then given the information on the book value of the subsidiary, and that book value turns out to be $690. So now we know we're dealing with the differential of the two numbers here, and this is for the 100% amount. Doesn't represent the parent's portion, but we don't need to know the parent's portion right now, or we don't need to concentrate on the parent's portion right this minute. That differential is $313,400, and of course where we're going with this is we're going to try to figure out if there's any goodwill. That's what we're going to do, and to do that we'll do this kind of analysis, which is this kind of analysis in Chapter 3 we did at 100%, and we're going to do it at 100% here as well, because ultimately, even though we may have to do some 80% calculations, ultimately we're doing 100% value on the consolidation. So the acquisition date number is, let's try to get this to be a little bit more legible. Otherwise we're going to have some real fun times trying to read this. Alright, so let's just do 1,003,400. The book value is $960. Is it $960? Let's see. No, $690. Oops. Okay. Good thing I checked. $690. $313 is the differential. $313,400, I believe. Yeah, 400. And so now we want to see, let's see how it looks. Yeah, that's good. Alright, so now we want to explain this difference. Explain the difference is the type of schedule we do. The difference in the value of the land, of the fair value of land versus book value, is $225. How I'm getting this is just look at the problem. The information is given to you. It tells you the fair value of the land versus the book value, and that's where I'm getting all this information. The building goes the other way. The book value is greater than the fair value, so that differential here is going to have to go in parentheses because it's a negative. There is a copyright, that's the next line, and that copyright is worth $94 more than the book value. And then you have the accounts payable. Alright, so the loans are the loans payable. Alright, so that's where that comes in. We get fun here. So here's how you have to think about it. 176 is the book value, and 157.6 is the fair market value. So where do we go with this? What does this mean? So if we are going to need to reduce the loans payable, that's going to be a debit. So that's just like debiting the asset here. This is a debit, and this is a debit. So the direction of the differential is going to go the same way as those debits. Differential is going to be 18.4. So let's do it. Let's put that in here, and that's the direction it goes. It's not going to be in parentheses. It's not going to be in brackets like the 24,000. So let's see how this all works out. First of all, let's make sure I've got plenty of room here. And now let's see what the math is. The math turns out where's my calculator? That's how the math turns out. The math turns out that this explains the 313,400 to the penny. That's what it turns out. So this net, the net of all these numbers, meaning adding this, subtracting that, adding this, and of course, and this gets added, comes out to 313,400. There's no goodwill. That's what we've proven. And so we're ready to go to the next step. You want to see what it looks like? Take a good look. Ah, looks beautiful. What's all this over here? Okay, well let's get rid of that now. We won't need that going forward. And I should have been a painter. Such artwork. Okay. Alright, well what happens next in this section is everything that we've already done before. This is just going to explain the amortization. And what I'm going to do is I'm just going to indicate the years. This is the equipment part is going to be, I think that's the equipment 10 years, the copyright is 20, and the loan is 8. The direction of where the excess amortization goes for the building, rather for the building is pretty straightforward because the building was worth less than the book, so it means the depreciation differential, which is over the 10 years, 2,400, that's going to reduce depreciation. The copyright was valued greater than the book value, and over its 20 years, that's going to increase amortization because we're going to amortize the differential, and that's a 4, by the way, 4,700. And then the notes, do the same thing with the notes. If the note, in the case of the problem, told us that the book value, I knew I shouldn't have erased that before, the book value of the note is 176, fair value is 157.6. So in order to get that differential, what we did up here is we looked at it as being a debit. Why? What are we saying? In order to, if the books show this and the consolidated needs to show this, in order to reduce what is a payable, we have to debit the payable. So if we're debiting the payable, that means the amortization is also an increase to expense. An increase to expense. You know, it's not amortization, but it is, and you answered the question, it is interest expense each year. So now we know which way this is going to go. This is going to go as an increase in expense. The amount is $2,300 per year over the 8 years. The net effect of all this, I think the math will prove out right, to be $4,600. So every year of the life of this thing, we're going to be adding $4,600 of a net between amortization and interest expense and depreciation, if you wanted to say it that way. All right, so that sets up the problem, and we're now ready to really roll to the, let's just see the results of that. You can take a look at it, make sure you understand what we did. If you're not, oops, this is just chapter 3, so you need to go back. Now, you may say, well, wait a minute, you just did everything at 100%, and you're right. And that's because that's where we're going with the consolidated. But what about the fact that the parent only owns 80%? You're right about that too. That makes a difference. That means that the investment account on the parent's books under the equity method is 80%. The income from the subsidiary on the parent's books is 80%. So on and so forth. So we just need, that's all we have to do that's different between chapters 3 and 4. We just got to take into account that there's that difference in the parent's books compared to what we're going to end up with on the consolidated side. We shall see. That's what we shall do. So in order for us to see, we've got to go to the next page. So let's see how that works. Okay, well, it works pretty interesting. This will be fun. I'm not sure I can write that small on this program. So that should make for fun and games. All right, well, what I'm going to do here is stop, take a break, and figure out how to do this so I can present it for your enjoying pleasure.